We set the firm up in 1994. I set it up with my partner Bill Bollinger. There are 11 of us investing and about 40 people in the firm in all. We run about $4.2 billion, essentially in one strategy, which is European equities with a global bias. And we are substantial co-investors in our products. We were incredibly pleased when Schroders approached us. If you think about Schroders, it's a fantastic brand name which has been around for 150 years, and it's full of very high quality people. And it's a huge asset flow generator. Everyone we've met from Schroders has been absolutely first class, and we've really enjoyed working with them. And we've been enormously impressed by New Finance Capital, who have, I have to say, subjected me and some of my colleagues to some particularly grueling interviews. So we think Schroders is a name which is redolent of quality, and therefore we're thrilled to be partnered with them. The Schroder GAIA European Equity Fund will be managed pari passu with our existing vehicles, subject to the UCITS wrapper. And one important thing about the UCITS wrapper is that liquidity in the fund is weekly rather than monthly. So it'll be a way of giving people who want weekly liquidity access to our products. Our core long-short European equity hedge fund product has generated compound returns of between 16 and 17% since 1994, with an average net long exposure to the market of around 70%, significantly lower volatility than the market, and very, very modest use of leverage. In fact, I would say minimal use of leverage. And clearly the past is no guide to the future, but I am hoping that we will be able to generate attractive returns for investors in the fund, subject to risk, over time. Ideally, we're looking for the types of companies you'd be happy to own and unworried about owning if the stock market closed and you couldn't trade them. And what does that mean? That means businesses with strong balance sheets, strong cash flows, sustainability, and attractive medium-term growth prospects where you are not constantly worried about them going wrong. One of the great things about the markets is that they keep you young because there are always new industries evolving, new companies coming to the market. And quite honestly, I don't know the sorts of companies we'll be investing in over time. I do know that since I started, the remit of what we do has changed dramatically with changes in industry, and I hope this will continue. We have a preference for global companies rather than solely European or UK companies, and that's because we think global economic prospects are better than those in Europe and the UK. And we have a preference for industry winners. I think one of the ways the world has changed in the last 15 years is that it's become far more global than it ever used to be. And I think investors now think of China and the emerging markets as, in a way, being just as important as the US and Europe in the macroeconomic and financial landscape. Now, as an investor, you have to take this on board. And whether you invest directly in emerging markets or invest directly outside of Europe, it's quite clear that you can't be an investor in Europe without knowing about what's going on outside it. It's quite important to say what we don't do outside Europe, because after all, this is called a European product. And I would say there are two key constraints on what we don't do outside Europe. The first is we have a limited exposure to and view of the East. That's because we feel the East we're behind in the time zone. We feel it's more of an insider's market, and we're not used to dealing with command economies. And we feel it's harder to get access to companies in the East sitting in London, because apart from anything else, language is a barrier. But we feel that if you look west of Russia, you're able to get good access to companies in a reasonably accessible time zone, where English is the lingua franca, in economies and financial markets which we can understand. Where we have the most money outside Europe is in the US of A and in Brazil. Brazil mainly in domestic companies, because we think that the domestic economy will be the driver of the stock market over the next few years. And the US more in international companies. The US has many fantastic industry leaders. At the moment they have a bit of a tailwind because of the weak dollar, and we find some of these very attractive. I think if you look at the history of short sellers in the stock market, it's very hard to find short sellers who consistently generate double-digit returns over a market cycle. That tells me that short selling is a very difficult activity. But the fact is, short selling has in the past, at times, notably in the market downdrafts, added tremendous value to our portfolios. And the reality is, during a market downdraft, the market is going down because things are bad, and you never really know that it will turn better. And so short selling is a good hedge. Having said that, we do it in moderation because we don't want to lose too much money short selling in rising markets, but we want to have a foothold in the door so that when things change, we can raise our exposure. And the sorts of companies that we look to short are companies which essentially have the opposite characteristics to our longs: flawed business models, declining earnings, weak balance sheets. One risk is concentration, and I have a view that you don't want to be too concentrated. Concentration is great when it works, but when it doesn't work, it's a killer. So I believe that diversification is a free lunch given to investors, and I believe you can be diversified and reduce your risk and still perform. There's another risk, and that is leverage. And I have always felt that if you need to use leverage to outperform the market, you shouldn't really be in the business. We have therefore used leverage only very modestly in the last 15 years, and the bulk of our returns have come without leverage. A third risk would be liquidity, and the liquidity is the risk that you can buy but you can't sell, and that's clearly a horror. And that's why we put a very strict liquidity framework in place and have a huge emphasis on avoiding what I call lobster pot investments. Lobster pot investments are where you can buy but you can't sell. What else is risk? Risk is the risk of permanent capital loss. And there's not much anyone can really do about that, in my view, apart from avoid borrowing money and knowing what you own. We're not macro investors per se, and our portfolio is composed of stocks generated stock by stock, rather as if a house is built brick by brick and you select the individual bricks. And what we feel about the stocks and what we hear from the companies plays a major role in helping to determine our macro view. Because after all, if every company that you're seeing is telling you that its business has stabilized or is strengthening or is getting better, then you're going to think that the economy is getting better. But against that, you have to have some macro assumptions when you invest in stocks. We do, I think, have a first-class team, and we are very dedicated, we are very focused, we have one product, we're all basically invested in it, and we hope that it will produce decent returns for any investor that comes to Schroders.